a strange time because most of it's been covered up by everybody whinging about the Labour government and saying how they're raising taxes, etc., etc. But one thing I did notice in the press this week, I think it was actually this morning, Nationwide have announced their annual profits. Did anybody see that out there? No, it's just me who's the boring one looking at annual profits of the state agents, of building societies, that's what it is. They made a profit, a healthy profit of £925 million. Sounds great for them, but it wasn't actually that good for them because previously they made a profit of 1.25 billion. So what that actually says is they're not doing as well as they were. And it's the reason behind that is not because they don't have as many customers, it's because they've had to squeeze their margins. As the base rate has gone up, they've had price wars with the other lenders out there. And Nationwide have been very active and they've had to be very competitive. So what we've seen is these margins being squeezed and therefore the lenders' profits being squeezed. What we're expecting to happen is the base rate to go down, and it has gone down. But what we haven't seen so much is the actual lenders' rates go down. And you've probably seen in the press that mortgage rates have gone up, etc., etc. And this is actually partly because there's been so much competition, lenders are having to increase their rates slightly. The good news is though, Barclays did bring their rates down today, and they were the first one of everybody to bring them down. So, what's going to happen in 2025? Oh, that's probably Nationwide. So, what's going to happen in 2025? Well, we're expecting the base rate to go down, and hopefully off the back of that, we'll see rates come down. But what we're also going to see is stamp duty, the relief, actually finishing. And that happens in April 2025. So we're expecting this to cause a bit of an issue. And it's going to cause, in our opinion, it's going to cause a bit of a slowdown in house prices. So, if you're looking to sell, maybe not the greatest time, but could there be opportunities if you want to buy, especially if you can use investor finance or something along those lines. Talking about investor finance, actually, something just popped into my head. We're getting a lot of questions about what level of investor finance will lenders accept. And we're seeing some people come to us saying, can we use 100% investor finance alongside traditional bridging or whatever it may be? And the answer is for probably 80-90% of lenders, they will require you to put 10% of your own money in, even if you're using investor loans. There are a couple that will do it. They will allow 100% investor loans, but they tend to they tend to be slightly more expensive than. Is it back on? No. It doesn't matter. Right, they tend to be slightly more expensive than your normal bridging rate. Maybe just 0.1% more a month, something along those lines. So not the end of the world, but most lenders, if you're going to talk to a broker or direct to lenders, will require you to put 10% of your own money in. What else did I have to say? Stamp duty, spoken about that. One thing we've also seen is people returning to offices. People tend to not work from home quite as much as they did just after the pandemic. And what that has happened there is it's increased the value of offices because there's more call for tenants more tenants call for space, and therefore it's a more stable investment and the price of commercial is going up. And we're seeing that as one of the things to watch in 2025. Alongside that, I've spoken about that, first mortgage rate cut by Barclays, which is good news. I think that's really it for tonight's update. I can't think of anything much more that's been going on, but does anybody have any questions while I'm here? Alex?
Mark, can you explain why, when the Bank of England were reducing rates,
Yes.
banks were increasing?
Why they were doing
mortgage
that?
rates?
It's all to do with swap rates, and it's the amount of money that lenders can borrow and where they can see the yield curve going. And I suppose in layman's terms, it means the money that they're buying the money in for, predicted in the future, 5 years or 3 years, depending on whatever swap rates they're looking for, that will dictate the price they're actually giving the customer or the consumer on the street. So it's not the actual base rate that they're using to create a lender rate. They're using a swap rate which is slightly different from the base rate.
So does that mean even next year the Bank of England reduces rates, mortgage rates could still go up?
They could still go up. There's nothing to say they'll come down, but usually they do have a correlation. Last year was a bit of a strange one because they swapped over, they went the wrong ways. That's what caused a bit of turmoil in the market, but hopefully they'll be a bit more regular and they'll continue to go down as the base rate goes down. Okay?
So is it real money or is it just all virtual money?
What is real money? Everything's virtual.
It
It's a
seems
piece
as
of
if
paper.
they just talk about money, the banks, etc., but it's not real.
Yeah, it's
money
loan
as
notes.
such.
And it's all to do
Do they
with.
have the money?
Well, no,
They
not
don't,
necessarily.
They're just talking about it, aren't they?
So I won't get deep into it, but there's something called Basel III, which is a capital ratio a bank has to hold to be able to lend money out. So say it depends on what type of bank it is and the security of the bank, but you would potentially have to have £10 in your deposits to be able to lend out £100. And different assets in the bank means that they can lend out a certain ratio above that amount. And it's quite a complex system, but if you're looking at residential assets, lenders can lend more against a residential asset than they can do a commercial asset because the capital requirement that the bank has to hold is smaller for a residential asset than a commercial asset. It is complicated and it's something that nobody needs to worry about, I hope, unless they're into wholesale markets or anything like that. But in essence, money is virtual and you can lend more than you actually have. And that's what caused one of the reasons the crash happened in 2008, wasn't it? There was banks like the Bank of Scotland, where I worked, that were lending more money than they had and trying to gain market share, and therefore they got themselves in a little bit of trouble when people actually lost confidence and they asked them to prove the money they had, didn't have the money, and it all went wrong. So now there's tighter restrictions for banks and lenders on what they can lend, but I suppose worrying thing is a bank does have restrictions, but a lender, and what I mean are private bridging lenders, some of the fintech lenders don't have the same restrictions as a bank would have because they have different rules. So it's something to look out for. I hope that answers the question.
Just a quick one.
Yes.
For us as property investors, how do we get to understand the relationship between the base rate and the swap rate? So if we're taking decisions,
Yeah,
we know when to get it right?
it's a really good question. The economists don't get it right either. So it's not like anybody here can predict this. The only thing I would say, you can look on economic forecasts and everything online, you'll see them. There's a great Professor Trevor Williams. He used to be the head economist at Lloyd's, and I think he's the head economist of the NACFB, the National Association of Commercial Finance Brokers. He's really good to follow. He'll should point you in the right direction, but it's anybody's guess what happens. And the thing, I was on a panel a couple of weeks back at Central London with Brendan Quinn, and we had the people on the panel, and they all said, when you're investing in property, you need to find the right location, you've got to find something that's going to generate income, and etc. But the thing that I said was, you've got to think about the economic cycles, rather than just a small period of time. Hopefully that's the ball have scored. You can't be picking just a month at a time. Is the rate going to go up or down, or 6 months even? If you look, this is going a bit deep now, but if you look at the Keynes theory, it shows the peaks and troughs of an economic cycle between 12 and 16 years. So you can sort of predict when a crash is going to come in, or a rise in house prices. So you need to look at the trends, and it is really interesting. You can see it throughout history. You can see the recession in '92, you can see the one in 2008, you had the pandemic and Brexit and Liz Truss in the early 2020s. There, you see throughout history there is that pattern. So it's worth looking at the Keynes theory. It's very, very boring. I've read a lot about it, and it is terrible. But it's something that will give you an advantage if you can predict that. And Stephen Johnson, who is one of the founders of Shawbrook Bank, when he used to stand on stage when I was at Shawbrook, he used to say, property remains a leveraged transaction. You don't have to put in as much money as you can make. You know, it is leveraged, and it always has to be looked at on a long-term view. Even if you're flipping it, it's the long-term view of your flips. How many are you going to do to get to wherever? Because one will go wrong, definitely. You know, they don't always go right. If you're buying buy-to-let, they may lose on yield, but you may gain on capital appreciation, something like that. So you need to think about the overall strategy for the long term. And you know, Lucy was talking about the mission, and that mission, I presume, for property investors, other than people who just like a lot of houses and a lot of hassle, is probably to make a lot of money. That's something that takes time and effort, and it will happen. I personally don't believe in passive income. Every property investment I've ever known has been very unpassive. Unpassive or impassive? Whatever. Not passive. So it's something that you need to look at for a long-term plan, mission, and trying to pick it right.
But just to add to that is, I had a discussion with one of the directors at the bank, and you can look at it in a different way, in the sense that whatever you're doing, you've got the cost of the money and you've got the return. So ultimately, if you're making a return which is higher than the cost of the money, it almost doesn't matter where your interest is, because you can have a breach at 30%. If the deal is going to make you 50%, it still makes sense to do. So if you're looking at doing creative deals which gives you higher returns, then at some point you probably don't worry too much about the cost of the money. But as Mark says, you'll probably be looking at the longer term. By the time you get your returns, interest rates have gone down or have changed as things progress over time, then you're still doing well. So look at that well as well.
I think my most successful customers have been in one main group, and that's been the Orthodox Jewish community. They're the group that I've been working with for the longest, and who are the most stable and successful, because they sit on their hands and are patient. They wait for opportunities to come around. And every single one of that community that I work with is not jumping in at every auction or trying to get property through auction just for the sake of it, and not looking at their figures. They buy when they're ready to buy, and they make sure that there is a return. There's always a return on everything. They don't care if it's going to take 10 years, 20 years, whatever. It's the long-term plan. That's just what I've experienced. Any other questions?
Yeah, I can ask now.
Yes.
Well, you said, well, I can't remember which company, they made something like 1.2 billion last year.
Nationwide.
But they haven't really lost it, they just haven't made as much. When they say they've got a loss, like Tesco's or whatever, they say they've lost, they haven't really, they just haven't made as much as the year before, but they still haven't lost.
You are right. You are right. However, if you are somebody who is an investor and you're looking to invest money in a company and you see the trend of that company's profits going down, 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 that's something that you potentially won't invest in. And therefore, the confidence in that financial institution starts to wane, and that puts a lender in a very difficult position. It also puts the lender stroke deposit holder in a difficult position because people are less, I suppose, confident in that deposit holder to hold your money. Like I mentioned, the Bank of Scotland, if you put money in there in 2007 and that confidence went down and down and down, then it's not going to be in a safer place as maybe Barclays was or wherever. So what my point is, if you are seeing a downward trend, it's not a good thing for a lender. Yes, they are making profit, but their profit margin is coming down and it will potentially create a lack of confidence in that lender. The whole monetary system is based on confidence, and that's how it works. Like we said before, money is virtual, and if you don't have confidence in that, if you don't have confidence in a pound note, that money's worthless. And if you look at a country, I was watching, what's his name, Ramesh Ranganathan was in Zimbabwe the other day, and they had notes for $1 trillion, whatever their currency is. And it is because the confidence went and inflation skyrockets, and then the price of bread will double between you going from here to the front of the queue in Tesco's. It can happen, and it has happened in the UK, but less so than in less developed countries. So will Nationwide go under because of their small profit decrease? No, but would it hamper them in their I suppose designed to be the UK's leading lender for property? It probably will, yeah. Sharon.
I'm saying that's great.
Don't Sharon, I want some more questions.
I love your history lesson. We got the rap.
We'll do some Russian history. So my degree was in Russian history. So we talked to 1860. No, it's cool.
So time for some people to win some.
There you go.
Oh, we're back on.